Hi, this is Tony Raza, Senior Director of Multi-Asset Strategy at UOB Asset Management. We think investors should be increasing exposures to fixed income in 2023. Our house view is to be overweight fixed income, and in particular, we are overweight government bonds and high-quality corporate bonds. We're a little bit more cautious on high-yield bonds as there are uncertainties around the health of the global economy. In 2022, fixed income funds did poorly as interest rates rose and due to the fact that bond yields at the start of the year were so low. And it was among one of the worst years for fixed income historically. But into 2023, we don't think that should hold investors back. In 2023, we think fixed income is in a win-win situation. If, in fact, the global economy is able to avoid a recession, then fixed income can perform well because underlying bond yields are strong, and even if all that is achieved is earning those yields, fixed income fund returns will look healthy. If, on the other hand, the global economy falls into a global recession, then interest rates are likely to come down and inflation is likely to decrease. And in this scenario, then fixed income will not only benefit from the high yields that they're earning, but they're also likely to benefit from capital gains associated with the interest rate cuts. We think the outlook for equities is more uncertain. We think equities have priced in a lot of the risks of the slowing global economy, but it's unclear if they really can start to perform until we get better signs on global growth. It's been our view for the last 6 months, and it's kind of our view for at least the next quarter, that equities are likely to be stuck in a trading range, roughly 15 to 20% below the start of the levels that we saw in 2022. If we start to see signs that the global economy is avoiding a recession, then we think that'll be the time to start increasing our equity exposures. If, in fact, we see a global recession, then what we would look for are signs that the leading indicators around the world have bottomed. And it's usually at that point where equities start to perform off the bottom levels. By the end of 2023, we think there's a good chance equities can start to perform again. But especially at the start of the year, the outlook is uncertain enough that our house view is only to be neutral equities. During periods of slowing global growth, equity sectors tend to perform pretty similarly across most of the areas. But there are certain things that we think will be interesting to look for in the coming year. So firstly, we continue to overweight Asia. Our belief is that, one, China is reopening, and that's going to be a benefit for Asia overall. And we also highlight that Asia has stronger structural growth. And so in periods like now, where interest rates have gotten up to levels of 4 to 5%, that's a level that can slow down the economies of the developed markets, but that's actually a level that Asian economies have dealt with for a long time and are therefore a little bit less at risk of turning into recession on that front. Other areas that we're focused on are areas such as what we call value, which are companies with better valuations, and quality, which are companies with strong balance sheets and cash flows. Finally, we also like areas where we see strong dividends, and so we're buying dividend-paying companies that are providing good income. And like the story for fixed income, we think these trends are going to remain a healthy trend to look out for into 2023. " 2022 was a year where all asset classes provided negative returns except for cash, and even cash was losing value on an inflation-adjusted basis. I would hope that this doesn't hold investors back, because as we look out at the opportunities for asset allocation in 2023, we think there's good opportunities. In particular, we would overweight fixed income. This is an area that has lower risks associated with it, and the yield prospects and prospects for even stronger returns remain fairly significant. We would be more neutral on equities and commodities until the global economic environment becomes a bit more certain. Overall, valuations across the market in all the asset classes are better this year, and the prospects on a multi-year basis are looking better. We would encourage investors to start to participate in this.